Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk, Citi's Global Head of Macro, and with me today is Alex Saunders, our Quant Macro Head. Welcome to the show, Alex.
Thanks, Dirk.
We are recording this podcast at 9 a.m. on Monday, January 12th, 2026. It's early January, which is a time when investors put money to work in line with their views for the year to come. Usually a large part of that money goes into consensus trades, which therefore initially do quite well, before often eventually having a setback. It's therefore very important to know what consensus is. Not so much because investors are supposed to lean against it, they're actually supposed to go with it. But between now and end of January or end of March, often those consensus views get tested. So let me start on where we are entering this year. And initially, let's talk about the US economy. Consensus has US growth running a little bit north of 2%, and Citi economists largely agree, sitting at 2.2% for 2026 for the US. Inflation, they're a bit lower than consensus. Consensus has a CPI closer to 3%, while Citi has it moving towards the Fed's target. This is partly on housing, but also on an expectation of weakness in labor markets that they think will continue. This is partly, but not only, due to AI. This also results in more Fed cuts than consensus, where Citi comes in at 3 cuts to 3%, while consensus hits 3.2%. This is the result of benign inflation and a weakish labor market. The new Fed chair is not necessarily the key driver for this call. We don't think that Lisa Cook will lose her seat, and it's unclear if a new Fed chair can swing the board to aggressive cuts unless the data requires it. What is likely, though, is that a new Fed chair may stay further behind the curve if hikes were ever required later. The lower Fed funds means that our US Treasury forecast is at 3.75%, well below the median consensus, which has it roughly unchanged at 4.1%. Our rates strategists are looking for a steeper curve focused on 530s, especially later in the year when the coupons will have to be increased, probably in the November refunding. Overall, this economic outlook is quite risk-friendly, and it's therefore not surprising that consensus on equities is quite strong. For the S&P, the consensus forecast is coming in at 7,464, is roughly 7% upside, while Citi's strategy is sitting at 7,700, so low double-digit returns. So we are more bullish than consensus. Why is that the case? Well, we have lower rates than consensus without lower growth. In macro strategy, we do think that we are in a bubble in the US equity market, but we don't see it peaking yet, given liquidity, given sentiment not being overly stretched, and the last part of a bubble can be really quite lucrative. We are also still overweight tech. Recently, investors fell a little bit out of love with tech. We are not convinced, though. In the past, the leader in the bubble stayed the leader to the bitter end. Diversification can be helpful, of course, but most helpful when the bubble is done and when we are rotating out of tech. So at this stage, yes, there is likely some broadening, but we stay engaged in tech as well. Alex, talk us through consensus on the other asset classes and where we are sitting.
Thanks, Dirk. Yeah, so consensus on gold is yet again bearish, as it normally is. Going into this year, our commodities team has also been bearish, but they have emphasized the need to adjust tactically, really all throughout last year as well. So gold in particular has been a good trade from the long side for the global macro team last year. We've been neutral since October. ETF flows, at least as of last week, had been bearish, and that's kept us on the sidelines. But policy and geopolitical uncertainty are really key supports for that trade and the rally that we've seen in gold. We've had plenty of that this year to start the year, and obviously that's supportive of the trade. Moving to copper, consensus forecasts are also bearish there. This is our preferred long commodity expression. Base metals tend to do well when you see an upswing, when you have global economic momentum strong, and Citi indicators are currently pointing that way. I would note on copper, on base metals, that despite the sort of gloomy sell side forecasts, our work on asset manager positionings shows also a long bias there. FX is a tricky market. Now, since 2019, euro dollar forecasts from a consensus of sell side have generally been positive. And again, throwing back to the work on asset managers, they've been overweight euro for most of last year. Our FX team takes the other side of that based on three factors. The first one, which you alluded to as well, Dirk, is US growth, fiscal support from tax policy changes coming, not yet in the price. In Europe, good news already priced in from the fiscal side, and the AI, which is really a non-Europe-centric technology at the moment. On the global macro team, we see the year in 3/3. So that prevents me from giving the classic sort of sports analogies, unless you're an ice hockey fan. But the first third being that labour market weakness and the Fed easing that you spoke on the top of the call, Dirk, that will weigh on the dollar probably early in the year before we get those cyclical tailwinds that I just discussed from our FX strategy team, which would kick in. And then again, Dirk, you mentioned it at the top of the call, but term premium could rise into year end. That's what our rate strategy team is thinking. Coupon issuance may have to be increased at that time. That historically has weighed on the broad dollar. So Dirk, what about EM? What's the consensus there and how do you see it?
Yeah, thanks, Alex. So in EM, I think the preferred asset class for consensus is EMFX, the high yielders and EMFX. And we do agree with that. We also like EM carry baskets and think that can continue for longer. The enemy of EM carry are really volatility spikes, which are very hard to forecast. We have a methodology where we get out when the volatility starts to spike, but it's usually not a good idea to front run these type of events. So yes, consensus and Citi likes EM carry. And we don't fund it in dollars, but across some Asian currencies. So we are not quite as sensitive to the big dollar call here. The second consensus still seems to be the frontier. Our CEMEA team also has a trade in Egypt, so we are part of that, I would say. In local rates, investors are still long. We are a bit more skeptical, and that's because a lot of central banks are really getting stuck in the easing cycles, and that usually means the easy rates trade is behind us. There are, of course, exceptions, and there is Brazil, which hasn't even started yet, and so forth. But broadly speaking, rates will be trickier than last year. And then in credit, the consensus seems to be sort of down on the credit curve. Your Ukraines, your Argentinas, your Venezuelas, and so forth. And our EM credit team also has some of those type of trades. So broadly speaking, I think consensus bullish EM, but this year more focused on EMFX rather than EM rates. Alex, how does consensus fit in with your regime work?
Yeah, I think the regime work has been quite boring for the last year, but broadly correct. And it's in line at the moment with a sort of run it hot environment. So we classify that as normal. It means that stocks tend to outperform bonds. It means that commodities tend to do quite well. The details are quite interesting. So in line with our commodities team, the model is overweight in both gold and base metals. In equity land, European equities, so that cyclical factor at the top, overweight. In rates, US and Japanese bonds are sort of long time underweights, and the UK is the top preferred market in rate space. And despite the volatility that we saw last year, as I mentioned, that regime has sort of broadly been the correct one. The overweights in equities and bonds are making up the lion's share of return contribution, but the financing side, the underweight that we had in rates and credits, were detracting like very little to nothing at all. The other point to make is that in some sense, the asset manager consensus is in line with that as well. There is definitely a bias towards equities. There are consensus shorts in Japan and the US. I would say Europe is not the most loved market. And I'd already mentioned earlier, the base metals overweight is somewhat consensus as well. So Dirk, what themes are we positioning for?
Yes, we already mentioned some of them on the top of the call. So we still like the AI theme. So we like the NASDAQ, as we do think those type of stocks will continue to deliver, including the shovel providers, even though cyclicals will do well too. There is an election theme with the US, of course, being the most important one, the midterms. Usually the midterms are not overly equity bullish, and maybe that's especially the case if the administration should start to focus on affordability, i.e. more Main Street rather than Wall Street. But historically, that has not led to much downside early in those mid-election years. We have a theme which is based on the global expansion, the robust global expansion expansion really, and that's being long the base metals, which you already mentioned, Alex. There is central bank divergence as a theme. I don't think it's as clear cut anymore that you can receive most countries. You have to be more in relative value space. So, we think Sweden is a better idea than Norway, or to receive Canada, a better idea than Australia, and so forth. And the Canada trade also has a trade angle because USMCA will be renegotiated, and Canada is probably unlikely to hike before then. There's a theme of fiscal deterioration. That's a global theme. It includes the fallout from the Japanese election. It includes maybe the US out of the midterms, but also in Europe, where France is really quite unlikely to quickly get its fiscal house in order, while the UK is looking a bit better in terms of supply, so we favor the back end in the UK over France. And there is, of course, the theme of the new Fed chair. Again, it's not so much the case maybe that the Fed chair can just easily, aggressively cut interest rates. It's more that it could be slower to react if there were hikes necessary. So that's something to be watched as the year progresses. Alex, anything else from your side?
Yeah, I'll mention just a couple of things. And one is an outshoot really of our regime work. So if we do get that cyclical upswing, then we could move into an economic regime that we classify as sort of a recovery mode. In that regime, dollar correlations tend to fall. So as you had mentioned, Dirk, we like EM trade so that for investors that can, you can take advantage of that potential decline in dollar correlations with high carry versus low carry currencies. The second one is on AI power demand. So we think that data center demand could crowd out the power that's needed for aluminum smelting, and aluminum demand is particularly likely to be strong from China. So digital and AI infrastructure is a strategic priority. So that's one that our commodities team likes. Another theme we like is long equity versus credit. So we think that the next stage of AI expansion could be debt-led. That may lead to some pressure on credit. If we do get a significant downturn, we think that credit on a risk-adjusted basis is just as exposed as equities, but with much less exposure to the upside that you will get from an AI productivity boom. So that's it from my side.
Thank you, Alex. So overall consensus bullish on growth and risky assets, in particular equities, bullish on commodities, ex-oil, and emerging markets. Citi broadly agrees, and we know that consensus is often right early in the year before potential pullback by the end of Q1. I would also say, though, that at Citi, our analysts are more bullish on US rates, and we're more positive on US tech and prefer to hedge some of our equity risk with credit. Lastly, we are also somewhat more bullish the big dollar, but do like EMFX. Thank you for joining us for today. This episode was recorded on January 12th, 2026, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on Citi Velocity. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Next week's Research at Citi Markets Edition will be hosted by Scott Cronin, Citi's head of US equity strategy. And be sure to watch out for Research at Citi podcasts, which you can view on the same channel. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.